Hey guys, welcome to my channel. Brad here. So today I want to walk through how to value a stock quickly, okay? And we're going to be talking about Facebook today. So the whole idea in investing is that a bird in the hand is worth two in the bush, okay? Now, the way to know if it's worth laying out money today to get more in the future is to look at the future cash flows, estimate the future cash flows of a business, and discount those future cash flows back to the present value today. Okay? Because we need to know if what we're laying out today is worth what we're going to get back if we discount those back to today. So let's go through a discounted cash flow valuation for Facebook. We're going to calculate the intrinsic value of a share of Facebook stock. So here's how we're going to do that. First, we need to estimate the growth rate of Facebook, okay? And one way to do that is to go to Yahoo Finance, search Facebook. So I already have Facebook pulled up. Click on this analysis tab, and then we're going to scroll down, and we're going to see what analysts are estimating Facebook's growth for the next 5 years. So right here we see 14.33%. So that's kind of the aggregate estimate for analysts that are kind of covering Facebook stock. So we take that 14.3 and plug it in here for the growth rate for the next 1 to 5 years. And I have 1.143 just because that's an easier format to use as I'm calculating these numbers. But this is essentially representing 14.3%. Now, for years 6 through 10, there's no number for that in Yahoo Finance. What I did there was basically I'm assuming we're going to scale down from this 14.3% down to the 10-year Treasury rate, which I have for this example at 2.75. It is lower now, but I'm using 2.75 just because I think that's a better representation for this particular exercise than the current rate, which is under 1%. So the average of 14.3% and 2.75% is around this 8.5%. So I'm assuming 8.5% growth for Facebook between the years of 6 and 10. And then here is what we're going to be discounting these future cash flows back at. This is the discount rate. That's basically my required rate of return. And this is what Mohnish Pabrai uses for his discount cash flow valuations. And I think it's a good general number to use. So that's what I've got here. Now this terminal price to earnings ratio. The rule of thumb from Pabrai is to use 15 for a high quality company and to use 10 for a company that's not really in that high quality basket, okay? So companies like Apple, Google, Facebook, I would be using a PE of 15. If you're looking at, auto companies, if you're looking at Carnival Cruise Lines, companies where they don't really have a long-term moat, a sustainable economic advantage, they're not great businesses, they don't have a high rate of return on invested capital, I'd be using a PE of 10. So I've got 15 right here for Facebook. So basically all we need now is the last year's earnings per share, okay? So how we're going to get that is we're going to go into the Facebook 10K, which is the annual report. And you can find this if you go to sec.gov and you search for company, you type in Facebook, and then you'll be able to pull up their latest 10K. Now to get earnings per share, normally you would just pull from here. And I look at the diluted earnings per share. If you want to know more, you can look up what is diluted versus basic earnings per share. But right here you see 6.43. So that was Facebook's earning per share. Okay. Now that number you can see doesn't really follow the trend. You got 3.49, 5.39, 7.59. Facebook's earning per share has been growing pretty impressively since 2015. And then you look in the latest year and there's a bit of a drop. And the reason for that, Facebook got a $5 billion fine in, I don't know if it was 2018 or 2019, but you can see here it was accrued in 2019. So this, it's a one-time fine. So it kind of skews the numbers a bit. If it's just a one-time fine, we can kind of assume it's negligible in terms of Facebook's earnings. Facebook has a lot of cash as compared to debt. And so, if we're just looking at earnings, we want to add that back in, okay? So if you take the $5 billion fine and you divide it by the shares outstanding, which is 2,854,000,000 shares outstanding. Okay, so take 5 billion divided by 2.854 and you get $1.75 that we're going to add to this earnings per share. So that comes out to $8.18. So let's plug that in. $8.18 per share. And we see this populates. So this is assuming a 14.3% growth rate for the first 5 years, and then an 8.5% growth rate for these next 5 years. Okay. Now for the terminal value, this is taking this earnings per share in year 10 and multiplying it by our terminal price to earnings ratio. So this is basically in year 10, if we wanted to sell Facebook at a price to earnings ratio of 15, which seems very reasonable for a company like Facebook, we're essentially selling it at this price. Okay, so this is the cash we get in year 10 if we're going to sell this business. Now we want to discount this terminal value back to the present value. And so what we're going to do is we're going to divide by this discount rate to the power of 10, because we're discounting it back 10 years. So that's going to give us this number. And then for the present value of each of these earning per share years. So year 1, we're going to discount it 1 year. Year 2, we're going to discount it 2 years using this discount rate, 1.10, 10% discount rate. And then to get the present value, all we're going to do is we're going to take the sum of all of these years that are discounted back to present value and the terminal value discounted back to present value. So that's what this is. This is the present value of a share of Facebook stock, assuming these figures turn out to be correct. Okay, obviously we don't know what's going to happen to Facebook, but these are my best guesses for Facebook right now. So we've got a present value of $232 per share. Now the current price of Facebook, I just looked it up a few minutes ago. Today is the 22nd of April, end of day, $182.28. So right now, if I were to buy Facebook, my best guess is I would be buying it at a 21.5% discount. Now, since I'm a value investor, I want to get a fairly large margin of safety when I'm buying a company. Okay, when I'm buying shares in a company, I certainly don't want to buy at fair value. because that's going to really increase my risk. If I'm off on any of these numbers, then I have a greater chance of losing money. Now, if I buy at a significant discount from the present value, then I can still be wrong and make money. The greater discount I buy at, the greater my margin of safety, the greater my chance of making money, even if Facebook, doesn't play out this way with these numbers into the future. So with a company like Facebook, a quality company, I really want to buy it at least at 1/3 off. So a 33% discount from fair value. And that's what this number is. So my target price for Facebook is the present value that I calculated times 2/3, or a 1/3 discount. So my target price is $155 approximately. So if Facebook price drops down to $155, I become much more interested in buying at that price. Okay. Now, this isn't quite a discounted cash flow valuation. This is kind of a quick and dirty, just figuring it out, back of the napkin kind of calculation. But what I did was, so there's a guy, Aswath Damodaran, who's a professor at NYU. He's called the Dean of Business Valuation. And what I did, he valued Facebook in 2018, okay? So I basically pulled his valuation for Facebook. That was a different thing. From 2018, and I updated the numbers for 2020. These are based on 2019 annual numbers, which is one of the most recent numbers as of April 2020. And I did a much more in-depth discounted cash flow valuation for Facebook. And if you want me to dive into this, let me know in the comments. I'll make another video about it. But really, I just wanted to verify that my quick and dirty valuation of Facebook was, somewhat close to a much more involved discounted cash flow valuation for Facebook. And so let's take a look at what I got for that. Value per share, $235, using this much more in-depth discounted free cash flow valuation. $235. And so if we go back, here we're looking at $232. So this, very simple, very quick value exercise for Facebook. I was very surprised at how close I came to my much more in-depth discounted cash flow valuation for Facebook. So that was very encouraging to me. Yeah, this is it, guys. How to do a quick value for a share of stock. I'm going to be doing this for many more companies in coming videos. I really want to look at Moody's. Moody's is a great business that may be discounted at this time in the market cycle. I want to look at Google. Let me know if there are other companies that you'd like for me to value using this technique. I'm happy to do that. And of course, let me know if you have any questions about this in the comments. I will answer each and every question in the comments. So I'm hoping Facebook gets down to this price in the next few months. I will definitely load up on it if it does hit that price. All right, guys, hope you enjoyed this. Smash the thumbs up button if you did. Hit that subscribe button for more videos like this. And I will see you guys in the next video. Take care.